In the 1950s, a Hungarian dancer named Nicolas Darvas turned $35,000 into $2 million in the stock market with one simple strategy: the Darvis Box. Darvis was an interesting fellow. He was a professional dancer who fled Hungary to avoid the Nazis. He was also an avid investor in the stock market. His book, How I Made $2 Million in the Stock Market, is a trading classic, and it covers his method known as the Darvas Box. To make things as simple as possible, Darvas Box Method consists of buying breakouts above 52-week highs and letting his winners run while cutting his losses extremely short. Where have we heard that before? He had the benefit of trading during one of the strongest bull markets in history, but if you take his advice of buying strong trending stocks in growth industries, like tech for example, you might be able to take advantage of his system to this day. We, however, are day traders, and we want to see how this method plays out intraday with long and short positions. So let's get right to it. Hello traders, the first thing that we're going to do is look at Darvis's method in a traditional form where he would look for a 52-week high, and then we're going to go over to the little bit more complicated day trade version of that. All right, and we'll see how that works. But the first chart that we're looking at here is the weekly of Facebook. Okay, so Darvis looked at weekly charts, and he was trying to find a chart with upward momentum in a growth sector. I would say that Facebook over the years has been exactly that. And we were in a massive bull market for a long time, many years before the coronavirus made the whole market sick. So we're going to take a look at this because this was kind of his ideal scenario. All right. So if we take a look at the 52-week chart here, you'll see that you've got the chart moving up to a new 52-week high, which happened about right here. So what Darvis would have done is drawn a line across here. All right, and then pull that down. You make your little box. You can see that there's slight little consolidation there. And then once this broke above the box, he was going to buy. And what he really liked to see was down here in the volume. He liked to see an increase of volume sort of for conviction that this was a big buying that was going to move the market. And in this scenario, this first scenario, that's exactly what we get. We get volume right with the breakout. It's kind of perfect. You buy there. It doesn't matter that it comes back just a little bit. Darvis would have had his stop somewhere in the middle of this box probably. He kept really tight stops, and he was going for big winners. So he wouldn't have been in danger of getting stopped out there. Market moves up a decent amount. It comes back, never comes back into that box. And in fact, in this scenario here, let's get another line drawn on here. Darvis would have gone for another long. So this is another 52-week high. Draw that across, right? Pull that down. Here's your next box level. As soon as it breaks above that, again, it is on increased volume right here. If you look down here, you can see that. And then it starts moving up again. And again, it's moving up nicely, okay? Now, at some point on this big pullback bar here, he would have been stopped out. He would have been having some sort of trailing stop up here. He probably would have drawn some other boxes in this area. And when this came back, he would have been stopped out. But that doesn't stop Darvis. He's going to get right back in at this 52-week high here as soon as it breaks above that, although there is no increased volume there. So he might have skipped the trade, but he often put buys, just buy orders waiting above the breakout. So as soon as that happened, he would have bought in. He wouldn't have been able to see the volume yet. He might have been concerned anyway and ready for that tight stop. The market comes up a little bit, comes back. In this situation, he indeed might have got stopped out. Let's see if we can. The box probably would have been somewhere in there. His tight stop might have just barely been hit, okay? But again, you can see the box right up above here. We'll just move that one up. And then as soon as it broke out through here, he might have got back in once again, and so on and so forth. You would have had a trade here. You would have had a trade here. That would have been the really big move. So on Facebook, over a period of multiple years, 4 years, what we're looking at here, you just would have been crushing it with profits with very, very little risk involved. But again, that's of course the ideal scenario. Okay, so now let's get over to a day trade scenario. So this is from Friday. This is the ES, and as we all know, the ES has been a bit wild lately. The E-mini S&P. I've got a 1 minute chart up, and we're going to start, somewhere around the 7 o'clock area. And we're going to just start applying his method here. Now, the problem with this, with day trading, is we don't have 52-week highs, right? We would hardly ever day trade. And even if we wait for a high or a low of the day, you're going to get very little entries doing that. And some days you won't get any at all. So what we're going to try to do is just identify new market momentum and then play the highs and lows off of new market momentum. Okay, now that is a bit subjective. It'll take some art. Day trading is not perfect, so just keep that in mind. So the first thing that you'll notice, the market's kind of going sideways, but then you get this big move up, and it comes back, and we've drawn a 21 EMA kind of as our measuring point of which side momentum is on. And you can see that you would have been looking for longs after this big move up. And so if the market goes down, you just don't trade in that situation, okay? So you're really in no danger of taking an accidental short here. So we draw a little box, and then when the market comes over here and busts out, you're going to be taking that long. And then a couple bars later, you do get this is a cumulative delta volume one. I wanted to put that up so you could see who was winning, buyers or sellers. Okay, so it's going to give you the relative volume of who was in control. And so that is a good move. You could have rode that one for quite some time without any danger of anything happening. So that would have been nice. And then once again, you're going to draw this over here. You're going to bring it down. Now you don't know where the lows are, right? So at first you would have brought it down here, but then it didn't go back up. It came back down. So then you bring it down here. So, there's your little box scenario. And again, if this goes short, the market's been trending strong up. So you're probably not thinking that the momentum is to the downside, right? You're probably still thinking, well, if I get another long opportunity, I'll take it. And again, once it breaks out of the top, which is right here on this big volume delta right here for buyers, you get a little nice move, and again, no danger of getting stopped out. So far, so good with this method. Now, as we come over a little bit here, you'll see something. You still would have been looking for longs, right in here, and it just never gets back up there. Okay, it just kind of keeps going lower. So if you happen to have been, really on top of your game and thinking that this was going down, as soon as it broke below this line, you would have gone short. I think that's a little early to try to catch a different momentum move. But let's keep moving over to the side here. If you were still looking for longs, you got to be looking for this one back here. So you're really not in danger of taking one of these short little moves that don't really make it anywhere. And then this is where it gets tricky, okay? So you're probably thinking short in this area at this point in time, so you're going to get stopped out fairly quickly on this trade here, right? I mean, you even get a little bit of decent volume delta going on, so you're probably going to get stopped out there, but no worries, you made two giant moves, and you're just going to take a baby loss here if you're following the method correctly. And then by the time, let's stretch this out a little bit so you can see it a little bit better. As by the time this comes up and then comes back to this EMA again, you should be looking for longs at this point in time. And as it breaks above As you can see, you probably don't even need to draw the box, but you can see that there is good consolidation coming across here. You could probably just draw the top or bottom line. But as it breaks through there, it comes back. You may have got stopped out on this one, depending on where your stop was. You may have survived, and even if you did, maybe you got stopped out again to this side. So, like I said, you need the strong momentum for this method to really be beneficial for you, but it can definitely give you some big winners. Now we're going to skip ahead a little bit and go to the downside just so we can show you a good sell-off. So in this situation, you know, you've sold off pretty good so far, and we'll steal this line from over here. We'll put this one there and this one across here. And so you don't know yet that this is going to come all the way down and break through. You're just waiting. That's kind of the cool part, is you can just wait. You can put your stop right here, and as it breaks through, you catch that move, and it's tanks quite a bit to the downside. And even if you wanted to add on later, because you definitely know you're in downward momentum at that point, when it breaks through there, you catch kind of the move of the day. It just drops like a rock. So on this day, it would have worked out pretty well. Of course, we're looking at the chart in hindsight, a lot easier to see these levels to make these plays, of course. So do your own due diligence, work this into your own methods. But it's a cool method, one that you don't see very often. But right before we go, there is an actual indicator on NinjaTrader called the Darvas Box. I was drawing it by hand for a reason. So we'll pull up the Darvis. It's called just Darvis, actually. And it draws these constant boxes. Okay? And it just gets messy. Let's get this out of the way. And it just gets messy. So you've got box and box and box and box, and it's drawing these constantly, and it's confusing. It doesn't give you the opportunity to spot your areas. And I think you're better off just drawing it by hand, is the point that I'm getting at. So I think you'll do better that way. But if you want to play around with the indicator, go for it. All right. All right, guys, that's it for me. I'm out. Have a good one.